Welcome back to my YouTube channel. Real quick shout out to Kiara, Rosa, Scott. Shout out to Baby Prince. Where you at, Baby Prince? Haven't heard from you for a while. All right. So today we're going to be talking about Netflix. We're going to do a Netflix analysis, stock analysis. I'm going to look into the business. For those that don't know, Netflix is a streaming company. That's pretty much based out of the U.S. and is expanding globally. And disclosure, I do not hold a position in Netflix, so I don't have any shares in Netflix. This is pretty much going to be analysis due to a conversation I had with a Netflix shareholder, and I pretty much told him, hey, you know what? I'll do a Netflix analysis and I'll put it right on my YouTube channel. So I hope you all enjoy it. You all get to see some stuff that I look into. But without further ado, let's get into it. All right, so let's go to the summary. We'll go to Seeking Alpha on the summary, and we'll just, based on the overview, the company is headquartered in California, and once again, they're a streaming company. They've been founded since 1997, but they went public in May of 2022. All right, we'll look at the stock chart real quick. Seems like growth is happening. All right. So kind of near an all-time high-ish, not really, kind of up there, but we're gonna see where Netflix stands, and we'll look at the valuation. We'll look at some other metrics and so forth. I listened to the conference call. I've reviewed their 10K. I've looked over their financials from their last conference call. The some takeaways that I've gotten from the conference call. Their conference call formats are more Q&A based, and I think that's okay, as long as they're more transparent on things, which is one thing I want to talk about. Let's look at their letter to the shareholders. Paid membership reporting. This is something that's changing with the company. They no longer want to report subscriber membership metrics, all right? And this is becoming a problem, for the market, at least temporarily. This is why you saw a dramatic drop in their stock. So, and not this dip right here, but I'm talking like, this is how it, we saw this little, let me do this real quick, bear with me. Okay, like right here, you see this little dip right here, and towards like a few weeks ago or so. This is because Netflix they decided to change their reporting mechanism, and that kind of spooked the market. The market does not like uncertainty. Why do I think that, there's a lot of speculation, but why do I think that they're going to change their paid reporting metrics, or they're going to change their subscriber metrics to where they're not reporting the amount of subscribers they're gaining and so forth, and it's averse to, okay, so this is why I think when they're expanding to different countries, the membership rates are going to be different. So if they're expanding into more third world countries and different, in different areas, subscriber growth as averse to paid subscribers, okay? The new paid subscribers are going to be paying a less of an amount, and they do not want, and it's just not going to look good. All right, it's not going to look good on their metrics, because they're going to be going through hard comps. You see, the majority of their base was in the United States, so American consumers pay the most money out of a lot of other countries. So, comparison to that, it's not going to look good on their growth metrics, and they don't want analysts projecting different models that can re-rate the stock and pretty much take a hit to shareholder value. So that's one reason why they're going away from subscriber paid membership reporting. Okay, so yeah, that's one thing to consider. In the conference call, the management seemed pretty confident that there's a lot of growth to be had. I haven't really been following along with Netflix, but due to my analysis, I'm like, okay, well, maybe they have a long TAM, that they feel like they have a big long TAM that they still need to penetrate. And for those that don't know, that means total addressable market. The amount of households that need to that don't have Netflix, cable cutting, and so forth, we're a long way from saturation of the market, apparently. So that's interesting. Okay. Um, in the conference call, they talked about different things. Another thing that management is pretty much guided is um, they want to start branching more out to like sports and stuff, and they got the live events like the Mike Tyson and Jake Paul fight, and the NFL, and a new thing that came up was NFL game on Christmas Day is going to be on Netflix apparently. So that's some exciting stuff. Their actual research and development and capital expenditures, investing into new Netflix shows and so forth. They're going to continue to be disciplined, but they do intend to continue to invest heavily on, their own proprietary Netflix original content. All right. So that's something to consider. So they're projecting double-digit growth. Real quick, we'll go to Seeking Alpha earnings. We'll start getting the numbers of things. Like I said, yeah, double digits. They're projecting double-digit growth as far as the eye can see for several years, if not decades. So they're looking at 15%. So a lot of these analyst targets from the years out, these are probably inaccurate. So at least that's what I took from the Netflix management, that they're looking at double digit growth for at least the next decade. Okay. Now let's look at what they've done. Look at their income statement. Growth is real solid. I mean, this revenue is climbing. It's very attractive. Shares outstanding. Diluted shares and basic shares. They bought back some stock. Another thing that they guided on from what I understand from the management commentary, is they're not going to do heavy buybacks. They will do buybacks as they see fit. So if they think the stock is undervalued, they'll just buy back a chunk of stock there. Okay. And they'll take it as it comes. All right. Which I can appreciate. All right. 10Ks, I reviewed the 10K. Everything seems to check out. Their auditing is good to go. And whenever you look at a 10K, sorry, let me give me a second here. Sorry about that. So whenever you look at a 10K, make sure that the company has been audited by a company that falls under the PCAOB. Okay. And most American companies, they all pretty much have this audit. And in the 10K, you'll have a letter that pretty much states they conducted the audit under the standards of the PCAOB, and they'll have some sort of they'll have the actual letter from the actual auditing accounting agency. So I look for that. I look for that with foreign companies mostly, but this is one thing that I check off the list, because sometimes and it happens sometimes, some of these companies, they don't have their financial audit in, and the actual indice like Nasdaq or S&P, they'll say, okay, you disclosed it, we're going to give you this much amount of time to get your audit in, and or we're going to start threatening to ban you off the indice and get the SEC involved and so forth. So that's something to take a look at. But these big companies like Netflix, I mean, they're going to have their stuff tip top. Let's go to their, and another thing I noticed with their 10K, let's go to their debt maturities. Guidance from management. Their intent is to not pay down the debt. Their intent is to refinance upon the maturities. Okay? They're and as a shareholder, I don't really, well, I'm not a shareholder, but if I was a shareholder, I would disagree with this. I think that this is not the environment to be refinancing senior notes. Let's look at it. So this is the table of maturities right in front of us. These are all their debts and when they become due. When these companies issue out debt and they have bonds out there against their debt, they have these senior notes. It's different from corporate businesses. When the maturity happens, they owe all that money up front, or they owe all that money upon maturity of however much is left, or they have to refinance the debt. Okay, I mean, they have a decent spread. All their debt is like pretty much spread out from year to year, as you can see. I don't see any debt maturity walls that are threatening to their free cash flows. We'll go back to the financials. Speaking of, we'll go to their cash flow statement. We'll go down their levered and unlevered free cash flows. There's not much of a gap in between. The unlevered free cash flows, once again, is if you've been following on my channel, these are the actual cash flows that don't account for the debt. All right. Levered free cash flows is the free cash flows that I like to call the pure free cash flows. These are the cash flows that the company has after they pay off their debt notes, or their minimum interest payments, if you will. And as you can see, these from year to year, these free cash flows have been growing really nicely. And they're going to use these free cash flows to, maybe they'll buy back a little stock, maybe they'll do some refinancing on some debt, maybe they will do as they see fit with them. All right. There's no dividend, so that's something to consider. Net income looks strong. We'll go to profitability. Commentary on management says that, I mean, if I recall, they're stating that profitability is still gonna, their margins are still gonna expand. And they're gonna try to get this net income margin up to 25% is what I'm tracking. And hey, I mean, that's a long-term target. I mean, and their Netflix 5-year average looks like 13%. And who am I to say anything? I mean, they expanded the margin up to 18% from their from 13% to 18% margin expansion. This is a business that they're in the phase of expanding margins, getting more accretive earnings, and more synergies kicking in. As their revenue growth slows down to about that 15%, mid-teens, they can start focusing on bringing more value to boost their EPS, which EPS growth looks real good. I think that their forward P on what you're paying for growth, I mean, you're paying a premium for their growth. The peg is looking like 2, maybe about double. It's about double what they're projected. So on a price to earnings, on forward price to earnings, you're looking at a double from what what analysts expect for growth. All right. So it could be undervalued based on these growth metrics is not being up to date, being that they should be in the mid-teens, but who knows. All right. So yeah, that's stuff that I'm noticing. Netflix, that management strategy. I want to talk about management strategy. What's the proposition? from what I've seen, the numbers and the commentary and what the management strategy is to bring value to shareholders. To me, this is how I see it. Their strategy is more of a, we're going to take it as it comes. If the shares are cheap, we'll buy some share. We'll buy a little chunk of shares here. If there's some little investment in capital opportunity for research and development, and it's a good price, we'll buy a little chunk there, and we'll that's how we're going to boost our return on equity and more value to bring more value to shareholders by beating market returns that way. And the EPS growth, and revenue growth rates, these all beat market. They beat the market and they beat inflation numbers, and they have a lot of they have a long way to go with market saturation, or the total addressable market, increasing margins and so forth. Something that I noticed as well, they have this credit revolving facility that they changed. All right. So let me see here. As of March 6, 2023, all right. This is a while back. Okay, I imagine this is like about a year ago, but they changed their credit revolver. Think of the credit revolver facility as like a credit card. Okay, they used to go off of unsecured debt through London, which is based off LIBOR. So, and let me pull this up. And they went from that to SOFR rate. All right, so we'll compare the differences. I got this little sheet up here for those who didn't know. So when it comes to LIBOR, it is there's a risk to credit, it's unsecured, and it's floated rate debt. It's more expensive. All right, and it's overseas. LIBOR is the rates that are, London, the banks in London, they choose the rates that fluctuates. All right, they have their own thing going. All right, in international currencies. All right, so far is more, it's US based, and they're secured debts backed by treasuries. So they have a bunch of treasury bonds on the balance sheet. All right, and these treasury bonds on the balance sheet, these treasury bonds on their balance sheet, that's backing their credit facility. So they're paying less because the credit is secured and it's backed by something. All right. So they're saving a little bit of money on that. The way, how do I view Netflix? I view Netflix as a blue chip growth stock. That's how I view Netflix. I think that Netflix is probably going to return. You can get you might get, how do you say? You might get your anywhere from 15 to 30% a year for capital appreciation with Netflix. That's how I view Netflix. They're still going to grow, and they have a long runway for growth, and their free cash flows are strong. Okay, and the way that they're pivoting their model to more paid advertising and more, and diving into live events, this thing has got a lot of potential to grow more. People see this as a big large cap company, and it is 264 billion, but I mean, long term, 20, 30 years from now, this be, trillions dollars in market cap, can be a $2 trillion market cap company. It could happen. All right. If they go global and they have this business model and their efficiencies are streamlined even more and more, this can be a way bigger company than it is now. Me personally, I like the smaller cap companies that have way higher growth rates. So that's just me, but I think that Netflix is more of the safer growth investment side. So I honestly think you can't really go wrong with just buying Netflix. Me personally, I mean, they're good to go. I mean, I don't agree with some of their strategies, but hey, that's to each his own. I mean, shareholders got their own opinions, right? So that's my take on Netflix. I think it's a great company. I think it's I think if people are buying this and averaging into it, I mean, I think they're going to be okay. They're going to get their growth. They're going to get that average return every year, or might come in a chunk every other year or so forth. But I mean, this management team is probably going to provide value to those shareholders. So that's my take on Netflix. I hope you all got value out of this. Like and subscribe. Check out my Patreon. I got exclusive content on there going all the time. And with that being said, enjoy the rest of your day and enjoy the rest of your week.